According to data from Morgan Stanley published in late 2025, money market assets surged during the Fed rate hike cycle, with investors chasing yields above 5%. But those yields have now dropped to 5 to 4% as the Fed cut rates. And you know what most people think? They think they're safe. They think they're being smart, conservative, protecting their nest egg. Let's be real for a second. They're not doing what Buffett's doing. They're doing the opposite. And that distinction is going to matter more than anything else in 2026. Here's the thing that nobody's telling you. Buffett isn't holding cash because he thinks cash is a great investment. Cash loses to inflation. Everyone knows that. Buffett's holding cash because he's waiting. He's preparing. According to a December 29th analysis from the Motley Fool, Buffett's moves are guided by valuation, not fear. The S&P 500's Shiller-Cape ratio hit 39.42 in December 2025, a level only seen 3% of the time in the index's 68-year history. The last time it reached these heights? October 2000, right before the dot-com crash. Buffett's own favorite measure, the ratio of total market cap to GDP, now sits at 224%, way above the 200% threshold he warned about in the early 2000s. You see, in corporate terms, this is like a seasoned CEO clearing the balance sheet before a major acquisition. You don't do that because you love holding cash. You do it because you know something valuable is about to go on sale. The question isn't whether Buffett thinks the market is overvalued. The data confirms he does. The question is what happens to all the people who think they're copying Buffett's playbook by parking money in safe assets when they're actually setting themselves up for the exact opposite outcome. Now here's the kicker. The average American investor sees Buffett's cash position and thinks, smart guy, I should do that too. So they move everything into money market funds, treasury bills, high-yield savings accounts. They're earning 5%, maybe 4% if they shop around. According to Kiplinger's January 2nd report, financial advisors are now warning clients that the days of easily earning 5% or more on cash have passed. Rates are drifting down to 2 to 3% in some cases as the Fed continues cutting. The Federal Reserve's latest projections show the Fed funds rate declining to about 3.75% by the end of 2026, which means money market returns will keep falling. But that's not even the real problem. The real problem is this. When the market corrects, and history says it will, those same people in safe assets won't have the capital position to buy. Let me explain what I mean. According to an analysis by A Invest published December 27, 2025, Buffett's 380 WARS, 7 billion cash hoard represents a calculated war chest for a potential 2026 correction. The historical pattern is clear. Markets don't stay expensive forever. When valuations reach extremes like we're seeing now, corrections follow. Not crashes necessarily, but sharp pullbacks that bring prices back to reality. The dot-com bubble, the 2008 financial crisis, the COVID crash of 2020. Each time Buffett was positioned with cash to buy quality companies at fair prices. That's how he built generational wealth. You see, there's a fundamental difference between Buffett's cash position and yours. Buffett manages hundreds of billions with a team of analysts, instant execution capability, and access to deals regular investors never see. When stocks drop 20-30%, he can deploy $50 billion in a matter of weeks. But here's what happens to the typical investor who thinks they're following Buffett's lead. They park $100,000 in a money market fund. They watch it earn 5% while the market keeps climbing for another 6 months. Now they're down versus the market. Then when the correction finally comes and quality stocks get cheaper, what do? They panic because they've conditioned themselves to see cash as safety and stocks as risk. So instead of buying the dip like Buffett does, they hold cash even longer, paralyzed by fear that things might get worse. Let me walk you through what actually happened during past cycles. In March 2020, when COVID crashed markets, the S&P 500 dropped 34% in 23 days. Buffett deployed billions into energy companies and banks that were trading at deep discounts. Regular investors? According to Morningstar data from that period, retail investors pulled money out of equity funds. They moved to safety. By the time they got comfortable buying again, the market had already recovered 50% from the lows. They missed it. The pattern repeats every cycle. In 2008, 2009, during the financial crisis, Buffett made deals with Goldman Sachs and Bank of America that locked in billions in profits. Meanwhile, according to Federal Reserve data from that period, household equity ownership plummeted as investors sold into panic and parked money in CDs and savings accounts earning less than 1%. By the time they returned to stocks in 2012-2013, they'd missed the entire recovery. Now here's where the institutional trap really kicks in. The financial services industry profits when you keep money in these safe products. Money market funds, treasury bill ETFs, high-yield savings accounts. They're marketed as prudent, conservative, responsible choices, and they are. For short-term cash, you need for liquidity. But for wealth you're trying to grow over 5, 10, 20 years, you're being sold safety at the cost of opportunity. According to Charles Schwab's educational materials on money market funds, these products invest in high-quality, short-term money market securities and aim to maintain a stable $1 net asset value. That stability sounds great, but stability isn't the same as growth. A Yahoo Finance analysis published January 8, 2026, notes that when rates fall, money market funds see outflows because the yield on risk assets like dividend stocks becomes more attractive. Translation: smart money moves out of cash when the opportunity cost gets too high. But retail investors, they're still flooding in, chasing safety. Let's break down the math because numbers don't lie. If you park $100,000 in a money market fund earning 5% for the next year, you'll make $3,500. After inflation, which the Fed targets at 2%, your real return is about $1,500. That's 5% real growth. Now let's say the market corrects 25% in 2026, exactly as historical patterns suggest when valuations reach these extremes. A quality S&P 500 stock index that was at $7,000 drops to $5,250. If you had $100,000 ready to invest at that moment and the market recovered to previous highs over the next 2 years, which it has done after every correction in history, you'd be sitting on $133,000. That's a $33,000 gain versus a $1,500 real return in cash. You see, this is the difference between Buffett's strategy and what most people are doing. Buffett's cash is ammunition. Your cash is a bunker. One is offensive, positioned to capitalize on opportunity. The other is defensive, positioned to avoid pain. And in markets, the people avoiding pain systematically miss gains. But here's the truly concerning part, and this is what worries me most about 2026. According to the Motley Fool's January 13th analysis, the S&P 500's average CAPE ratio of 39.4 in December is the most expensive valuation since October 2000. The index has only been this expensive 25 months out of 816 months since 1957. That's 3% of the time. Every single time valuations reached these levels, corrections followed. In 2000-2002, the S&P dropped 49%. In 2007-2009, it fell 57%. In 2020, it crashed 34% in 3 weeks. The difference this time? In previous cycles, retail investors at least had some equity exposure when corrections hit. They took losses, sure, but they were positioned to recover. This time, millions of Americans are in cash, thinking they're safe, waiting for the storm. But when the storm passes and stocks are cheap, they won't buy. History is painfully clear on this pattern. Retail investors buy high and sell low because they chase performance and flee risk at exactly the wrong moments. Legal and regulatory experts are starting to notice this dynamic too. According to Vanguard's published warnings about money market funds, these vehicles cannot guarantee they will maintain a $1 share price, and investors could lose money despite the fund's conservative nature. During extreme market stress like the 2008 crisis, some money market funds broke the buck, falling below $1 per share. The SEC even had to step in with emergency measures. So this idea that cash equivalents are completely safe, it's not accurate. They're safer than stocks, yes, but they carry hidden risks that most investors don't understand. And there's another risk nobody talks about. It's called liquidity risk. According to an analysis by GEICO comparing money market funds to treasury bills published in 2024, significant redemptions may force a fund to sell its most liquid assets to meet withdrawal demands, leaving remaining shareholders with a portfolio of longer duration, less liquid assets. Translation: if everyone tries to exit at once, you might not be able to get your money out, or you might get it at a loss. This happened in March 2020. According to reporting from that period, money market funds experienced massive redemptions as investors panicked. The Fed had to step in with emergency lending facilities to stabilize the sector. Regular people holding these funds didn't realize how close the system came to seizing up. If you think your money market fund is as safe as FDIC-insured bank deposits, you're mistaken. Bank deposits are insured up to $250,000. Money market funds are investment products with no such guarantee. Now, here's what all of this means for you right now as we head into 2026. Buffett's warning is loud and clear, even though he's not saying it publicly. His actions speak volumes. 12 straight quarters of net selling, a record cash position, valuations at historic extremes. The message is simple. A correction is coming. Maybe not tomorrow, maybe not next month, but the setup is undeniable. But here's what Buffett is also showing you. He hasn't sold everything. According to the December 2025 Berkshire Hathaway portfolio data, he still holds $267.2 billion in stocks. He kept his core positions in American Express, Coca-Cola, and other stalwarts he believes in long term. What he sold were the positions that got too expensive relative to their fundamentals. That's disciplined profit-taking, not panic selling. So what should you do? The answer isn't to copy Buffett by moving everything to cash. You're not Buffett. You don't have his team, his timeline, or his ability to deploy capital at institutional scale. The answer is to be intentional about asset allocation based on your timeline and goals. If you need money in the next 1 to 2 years for specific expenses, keep it in money market funds or treasury bills. That's appropriate. But if you're saving for retirement 5, 10, 20 years away, staying in cash during a market correction is the worst possible strategy. You'll earn 5% while inflation eats 2% of it, netting you 5% real returns. Meanwhile, you'll watch quality companies trade at discounts you won't see again for years, and you'll be too scared to buy. Here's what the data shows works. According to research from multiple academic sources over decades, dollar cost averaging into diversified index funds during corrections produces superior long-term returns versus market timing. You don't need to predict the bottom. You just need to be adding capital when prices are lower than they were. Buffett himself has said repeatedly that most investors should just own an S&P 500 index fund and keep adding to it. In his 2013 letter to shareholders, he wrote that a low-cost index fund will over time deliver better results than most professionals who are trying to beat the market. But you see, there's a reason most people won't follow that advice: fear. When the market drops 20%, headlines scream crisis. Your account balance shows red. Everyone around you is panicking, and that voice in your head says, get to safety. So you sell, or you stop buying, or you park everything in cash thinking you'll wait for the storm to pass. That's the moment you lose. Not because the market crashed. Crashes are normal. You lose because you stopped adding capital when stocks were on sale. You let fear override decades of historical data showing that every correction is followed by recovery. And when the recovery comes, you're sitting in cash earning 5% while the market climbs 30%, 40%, 50% over the next 2 years. Buffett knows this. That's why his cash isn't in a savings account. It's in short-term treasury bills that he can liquidate instantly when opportunity strikes. It's positioned, ready, waiting. The average investor's cash is different. It's hiding, and hiding doesn't build wealth. The stakes have never been higher. We're looking at a generational shift in market structure. Baby boomers retiring, needing income, Gen X and millennials trying to build wealth before it's too late, and a market that's priced for perfection, meaning any disappointment triggers selling. According to projections from multiple Wall Street firms, 2026 could see elevated volatility as the Fed navigates rate cuts, inflation concerns persist, and geopolitical tensions remain elevated. You see, the next few months will separate the investors who understand Buffett's lesson from those who just see headlines about his cash pile. The lesson isn't run to safety. The lesson is be prepared to act when opportunity comes. That means keeping some dry powder, yes, but it also means maintaining equity exposure so you don't miss gains while you wait. It means knowing what you'll buy if prices drop 20%. It means having a plan, not a panic button. Because here's the truth nobody wants to hear. Buffett will be fine no matter what happens. His wealth is generational, his team is world-class, and his reputation will outlive all of us. But your retirement, that depends on the decisions you make in the next 12 months. If you chase safety into cash and stay there through a correction, you'll miss the recovery. If you panic sell when headlines scream crisis, you'll lock in losses. But if you understand that market corrections are buying opportunities, not disasters, and you position yourself accordingly, you'll look back in 5 years and realize 2026 was when you made the smartest financial decision of your life. The warning is clear, the setup is undeniable, and the opportunity when it comes will be unmistakable. The question is whether you'll be ready to act or whether you'll be hiding in cash, watching from the sidelines as wealth transfers from the fearful to the prepared. Warren Buffett has made his choice. Now you need to make yours.